Hello. Um, we have spoken before about portfolio, and I have asked you to buy like 10 stocks or just to do them in watch list. And what is the idea behind the portfolio that I asked before to do in 2 videos is just to see that whatever you buy, for example, you make your own portfolio, okay? Own portfolio. Okay. Now, in your portfolio, for example, you bought 10 stocks. XY, ZE, FE, MS, DS, ES, RM. Okay, this is just symbols. It could be 3, it could be 4. This is just an example, okay? Just an example. So we have 2, 4, 6, OS, DR, MF. 2, 4, 6, 8, 10. Okay, you have 10 stocks. Okay, now you buy these stocks today, okay? Now, how do you buy them? Either use technical analysis, either use fundamentals, it means to see the company if it's earning more money each year or something. Now, I will try to give you just an idea how this own portfolio works. Okay, so year 1, year 2, year 3. Okay, because portfolio, it means you are investing, you are not trading. Okay, investing, it means for the long run, more than 1 year. Okay, so for example, the stock here, the first year you buy, it was, for example, this is 30, 20, 10, 5, 16, 18, 50, 100, 30, 32. Now this is the first price that you buy your stock, and then you wait 1 year and you see what will happen, okay, in the second year. Now this 3 becomes 50, this becomes 16 minus, this is plus, this, for example, becomes 35, this 5, it becomes $1, now this 16 becomes 18, this 18 becomes 20, 50 it becomes like 40, 100 it becomes 200, and plus 32, this 3250. Now this is just a scenario. Wherever you want to predict the stock market, you can't. Okay, you will never have an idea that what will happen in next year. Okay, no one knows. If someone tells you that he knows that the stock market will go up or will go down, he lies because it's the future. Maybe this guy, he will not be here, he will be dead. So how can no one knows the future. So this is something very, very important to understand about the stock market. Now the big guys, they can make a market for a stock. They can put it up or down because they have too much money, and they can buy too much shares, the stock go up, or they short it and the stock goes down. These people, some of them, they can market the stock, but we are not speaking about those. We are speaking about general idea about the market. Now you think that you wish that all the stocks go up and you make money. Okay, but some, they are like, you make money and some you lose money. Now, but for you, what you do, you will make a portfolio, all of this, okay? You add all the price first year, and then you add all the price second year, and you see the difference, okay? Suppose that you add all these and you divide by 10, okay, to have a price. For example, you divide all these. So for me now, I didn't do the math. But please, if you want just to do an exercise with me, just try to do this. Now have all these 10, okay? 10 stocks. For example, you find that there are $200. Just an example, okay? 10 stocks. $200. So you divide them by 10. So the average is, for example, 20. Now 20 is your portfolio price. Okay? It's very easy. That's why you are making your own portfolio. Okay? It's the same as the other mutual funds or ETFs. It's the same. It's the same idea. Mutual funds, okay, or ETFs, exchange traded funds, exchange traded funds. Okay, you do the same as they do. Okay, you choose your stocks according to strategy, or according to fundamentals, or according to analysis, like charts or something. Now, so you see the whole thing. For example, from 200 in the first year, they become 200 and for example, let's say a number. They become 300. 300 by 10, okay, it is 30. Okay? So from 20 to 30, you have 50% return. Okay? You have 50% return. Now, this depends on the year. If it is a bull market, most of the stocks go up. If it is a bear market, most of the stocks go down. So this depends on the market itself. So you don't control the thing. Now, why you add more stocks into your portfolio? Because you should diversify. Okay. So what does it mean, diversify? It means don't put all your stocks from one sector. For example, let's say internet stocks. Internet stocks. For example, if you buy Google, IBM, you buy, for example, Facebook, Intel, it means all the stocks that you see, or eBay, it means all the stocks are from one sector or one industry. This you will have more risk and more reward. Okay? Because if those goes very, very well, your portfolio will have, it will earn very much money. But if those go down at the same time, you will have a big loss. So we have what you call big reward and big loss. Okay? So that's why this is not diversified. Is not. So for you, you should be conservative. Okay? You should do conservative investing. It means your portfolio should go like this, like this. Okay? When you see the chart, you make your own chart for your portfolio. It should look like this. It means in each year, for example, each year, you are going up and up and up. You are making a profit, but through years. We don't see 1 year or 2 or 3, but you see all the years. Okay? Now, if you, for example, you like only one stock, You like only one stock, one company, what will happen? You have a big risk and a big reward. I will give you an example, which is very funny. Suppose before, 10 years ago, 10 years ago, for Google, for example, it begins with $10 a share. Now is $800 a share. An example, okay? I don't know the exact thing because I didn't check, so just an example. Now, from 10 to 800, so you have 10, you have like 10, let's say 1,000, you will get 8,000% of your money. Did you see this? 8,000%? It's not, but through the years, okay? Through, for example, 10 years. Now, this is what we call big reward and big, for example, from 1,000 shares, $10, 10,000. Suppose at that time, and for example, when the stock goes public, the Google go public. For example, let's say 2002. So it's not exact thing. I didn't see, but it's in this area when after the thing. So suppose it is you buy 1,000 shares with $10, and you say, I like Google. I see it has a future, and I see that the company before going public is a very good company. It's growing very fast, and I think that this stock will go good. So I will make a bet on it. Okay. So you put $10,000 and you buy what? How much money you get from this 10,000? You will get $800,000. Okay? It's nearly 1 million. So all the people who bought Google and they spent some money on it, now they are most of these people are millionaire right now. Okay? Do they do something very like what is it 10,000 in 2002? It's not a big money, okay? It's not very big money. But people who put 100,000, $1 million, $10 million in that stock, see how much they get. But okay? But the problem is that $10, it could go to 10 cents. Okay? It could go from $10 to 10 cents. So you will lose almost all your capital. That's why we have a big risk to lose all your money. But if you compare risk and reward is more because $10 it go to 800 compared to $10 it go to 10 cents. That's why investing always you think like this. Whatever you put in the market, for example, you put $10,000. Okay? You put $10,000 in the market. In one stock or many stocks. You put a bet, and you should think that even if you lose this $10,000, you will not be worried. Okay? This is you accept risk. Accepting risk is very important in stock market. If your stock go down a little bit and you go very quick and you sell this, it means you are doing trading. You are not doing investing. Most of the investors wait until 50% of the money gone or lost, and they get out from the stock when it is 50% or more or less. Some people they don't sell at all. Okay, depending on the people. So this is just a general idea how to make your portfolio. And since you don't have that much money to spend each month or each paycheck, for example, $50, $100, or $300 each month, so you try to buy each month, or 2 months, or 3 months, or each year, depending on how. But you should continue to buy and leave, continue to buy and leave, continue to buy and leave. Okay? Until you get your portfolio becomes bigger and bigger and bigger, and then if there is a good year, it can move very, very fast. So this is almost all the people what they do in order to invest. If you want to follow them, just have a plan and do as they do. Okay? That's why you see, when you see the stocks go like this, like the indexes, all the indexes you see like this. Okay? From here to here, always we're going up. But there is a risk of the market. You should accept this. Okay? Please, if you have any question, the number of stocks, for example, 10 or 5 or 20, it depends on you. Okay? You just diversify as you like. See industries, banking system, growth stocks, mining thing, pharmacy thing. You try to just try to diversify as much as you can. And believe me, there should be a great deal with it because it's conservative, and you shouldn't put your money on one stock, okay? Because you don't know, okay? But if you like risk, you do whatever you want, okay? So there are a lot of books that speak about portfolio. You can just take books and you read, and you just have more knowledge on how to choose your stocks, and then you can do your investment. But believe me that this is investing. Please be investing. It means for many years. It is not for 1 year or 2. Okay, it's for many years. It could be for your whole life. Okay, I will suggest another thing. Those who have the 401k, they can choose their mutual funds, and they do the same. Okay, they do the same with 401k. But 401k, you cannot take your money from it until you are 59 and a half, and it's not, maybe you put 10 years investment, and then you have some money and you want to take it out, so you are free. But in 401 you can't, so you have a problem with this. So thank you very much. If you have any question about this portfolio, and just ask me questions and comment. Thank you very much, and have a nice day.